Good afternoon, traders. It's about 12:15 here on Monday. I finished trading for the day. I might take a trade in the aftermarket, but I'm all done for pre-market and intraday. And I've been reflecting a bit on my trading this month, and basically this is all of my pre-market trading. I'm starting here December 7th just because I made some big changes. You see that blue line. I made some big changes on that week. So this is a little bit more representative of my current trading strategy and plan. And if you look, that most of these are green trades. The yellow trades, obviously, I did something wrong, and that's why those are in yellow. But even with those, a lot of those are technically green trades. So there's a lot more green trades in this area than red. That's the point I'm trying to make. And then if you go over here to my intraday trades, which almost all of these should be intraday. There might have been a couple times where I took a third trade or something in the pre-market, but I don't think so. So if you notice here, there's a lot of red trades, right? And so a lot of basically failed trades, failed setups, and most of them are ABCD patterns, 3-bar plays, things like that are pretty reliable setups. So, I'm starting to think why are these things failing? And I know, one thing that I'm doing that is putting me at more risk than normal. Okay, I just heard the Weeble noise and I'm thinking, uh-oh, did I just accidentally enter a trade? But I can't because I'm locked. So yeah, let me just share. This is one thing I'm noticing that I'm going to have to start being more strict about. Because I'm aware that, when you, let's say, of course, ACY is a bit of an extreme example, but I think this really makes sense. When a stock sets a high in the pre-market, like ACY did today at 789? And then no matter what it does kind of between then and the open, if it doesn't get back to that high, then it's not as strong as it can be if it got back to that high and broke through it. So I took a trade thinking, this was basically like an ABCD setup. When this pattern formed here, here's the A, here's the B, here's the C. Then I get in for the break of this candle, and then I got stopped out. And the reason why that is because we're still below the pre-market high. I've been ignoring the pre-market high once the market opens, and I think that's been a mistake. I definitely look at the pre-market high while I'm trading in the pre-market, but I figured there's so much more volume during the day than there is in the pre-market that I don't really need to pay attention to it too much. And I think part of that is also FOMO, because I'm afraid I'm going to miss like a big move if I don't get in right away. And that's what this is. So I think what I'm going to do from now on, and definitely come the new year, I am going to always have the pre-market high marked out, which I normally do, but I'm not going to take any trades until the pre-market high is broken and then gives me some sort of pullback. So probably the best entry here, not to say that I would have done this or this is going to work every time, definitely not. You see this thing runs up here, breaks through the high of day, then pulls back. So one entry would have been for the break of this level here, which would have been 819. So I would have liked to have gotten in there at 820. And then my stop would have been 732, which is a pretty wide stop. Let's just call that, we'll just call that 90 cents. And then, so it actually has to go up a whole $1.80 to get to 2R. So 820 plus $1.80 is $10. And it did it with ease. And again, this is a little bit of an extreme example. Will this work every time? I don't know, but the thing I do know for sure is that when a stock breaks through the high of the pre-market, and you notice, that's also higher than the previous day. That's a pretty important thing as well. That it's showing a lot of strength, and what that's going to do is going to get more buyers to come in. Notice the surge in volume. So this is all before the high of day was broken. The volume is way down here. And then as soon as the high, this thing starts, volume comes in and pushes it up toward the high of day. But as soon as the high of day is broken, you get the biggest volume candle of the whole day. except for the one where they're selling out at the open, right? That's all the profit taking. But short of that candle, you have the highest volume coming in here when this thing breaks the high day. 1.3 million shares traded on this 1 minute candle. Yeah, and here you have 5 million shares traded, but that's everyone that bought the day before or bought it during the pre-market that is just trying to take profit. So, but they're all gone by this point. So when this thing takes off, that's it. It pretty much, the other trade that I took, it's kind of shows the same, it kind of proves the same point, but just in kind of the opposite way. So it established the high of day, and then I took trades on it at the open, and they were failed trades. But my point was that if these stocks don't come back to the high of day and then break out through the high of day, they're not that strong. And what I did, the high of the pre-market, what I did was mark out the high of the day, and when it broke the high of the day, I waited for a pullback and got in, and I would get stopped out. But again, you've got all this pressure, all this selling pressure from people that are holding from here. So the whole point is that I'm going to change my strategy for the market open. I'm going to mark out the pre-market high, which I normally did anyway, but I didn't really wait for the price to get up to it. Watch for the price to approach and break the pre-market high, or set a price alert. And then once the high of the pre-market is broken, I'll wait for a pullback or consolidation like we saw in ACY, and then buy the first 1 minute candle and make a new high. And if I don't see that, I'm not going to take any trades, and that's going to save me a lot of money, because today, I had this is essentially a loser. 2 losers at the open. Actually, I think I had 3 losers at the open, because every single one of them, this one, I'm kind of screwing my setup here, and I changed my trade tracker. I'm working on it for January, and I'm going to include, instead of saying like, pre-market, intraday trade, I'm going to have trade 1, 2, 3, 4, 5, 6, and then have a note or sell here where I can put my session that I traded in, whether it be pre-market or intraday, because right now I'm kind of blending the two, and it's kind of screwing up my data, because this is not actually a pre-market trade. This is a intraday trade. And that was a loss because, again, I took a trade before it broke the pre-market high, and then this thing eventually broke the pre-market high and then went up 1,000%. So, that's just one example. But I know for a fact that if the pre-market high is broken, that the chances of the trade continuing higher are much higher than if you're trying to catch it on the way back up to the pre-market high. So that's going to be the plan for intraday trading from now on. So just wanted to share that with you guys, because I think it's a pretty powerful strategy. It's not like my strategy. A lot of people that are more disciplined take that approach, and I think the idea of going long on a stock before it breaks the pre-market high comes from my early days of trading, where I was a bit of a FOMO trader and just kind of wanted to get in at the first signs of strength. But now I'm much more patient, and I'm willing to sit back and just let things play out, and not take trades for entire sessions if I have to, until I see the strongest setups, because even the strongest setups fail. So might as well wait for those and give yourself a little better chance of success. All right, I hope this helps you guys. Let me know if you have any questions, and I'll see you in the next video.